Before we dive in, a quick but important disclaimer. I am not a financial advisor, and this presentation is for educational and informational purposes only. The information provided is not intended as a substitute for professional financial advice. Always consult with a qualified and licensed professional before making any major financial decisions. Your personal situation is unique, and the mortgage landscape can change. What if I told you that for the average American, a $400,000 home doesn't actually cost $400,000? It costs closer to $800,000. That's not an exaggeration. Over the course of a standard 30-year mortgage, millions of people will pay almost the entire sticker price of their home again, just in interest. Double. They'll hand over hundreds of thousands of extra dollars to the bank, not because they have to, but because the system is designed from the ground up to be confusing, intimidating, and to profit from what you don't know. Do you remember that feeling? Maybe you're feeling it right now. You're looking at listings online, dreaming of that backyard, that extra bedroom, that perfect kitchen. But in the back of your mind, there's this looming dread. This giant, foggy monster called the mortgage. And you know, at some point, you're going to have to face it. You're going to be sitting across a desk from someone, or staring at a 50-page PDF on your screen, filled with terms like amortization, escrow, ARM, PMI, DTI, LTV. It's an alphabet soup of financial jargon designed to make your head spin. And as you get ready to sign your name on that dotted line, committing to the single largest financial transaction of your life, a terrifying thought creeps in. Am I making a huge mistake? Am I getting ripped off? That feeling of powerlessness is by design, and today we are ending it. This isn't just another video explaining financial terms. This is your playbook. This is the step-by-step, no-nonsense guide to understanding the entire mortgage process from start to finish. From the moment you think, maybe I should buy a house, to the day you get the keys in your hand. We are going to pull back the curtain and show you exactly how the machine works. You will learn what the banks are looking for, how they make their decisions, where the hidden fees are, and how to negotiate from a position of power, not fear. By the end of this, you won't just understand what a mortgage is. You'll understand how to make the mortgage work for you, potentially saving you tens, if not hundreds, of thousands of dollars over the life of your loan. So let's get into it. To truly understand the mortgage process, we have to start at the absolute beginning. Not with interest rates or credit scores, but with a simple question: what is a mortgage, really? Forget the complicated definitions for a second. At its core, a mortgage is simply a tool. It's a financial lever. It's the most powerful tool the average person will ever use to build wealth. Think about it. Very few people have $400,000 in cash sitting around to buy a house. But with the tool of a mortgage, you can put down a fraction of that, maybe 20%, 10%, or in some cases as little as 3%, and you get to control a $400,000 asset. That asset, the house, will hopefully grow in value over time, and you get all of that appreciation, all of that growth, even though you only put a fraction of the money down. That's leverage. That's the magic of it. The bank gives you the rest of the money, and in return you agree to pay them back with interest over a set period of time. The house itself is the collateral. If you don't pay, they get the house. It's that simple. So, when you make that monthly payment, what are you actually paying for? This is the single most important, foundational piece of the puzzle, and it's something a shocking number of homeowners don't fully understand. Your monthly mortgage payment is almost always made up of 4 distinct parts. Remember the acronym PITI: principal, interest, taxes, and insurance. Let's break them down. First, P, principal. This is the easy one. This is the money you actually borrowed. If you bought a $500,000 house and put down $100,000, your principal is $400,000. Every time you make a payment, a portion of that payment goes toward chipping away at that $400,000 balance. It's the part of your payment that actually builds your ownership, your equity in the home. Next, I, interest. This is the bank's profit. This is the fee you pay for the privilege of using their $400,000. Think of it like renting money. If you rent a car for a week, you don't just pay back the value of the car. You pay a rental fee. Interest is the rental fee for the bank's money. Now, here is the critical, mind-blowing part that the entire system is built on. In the early years of your loan, the overwhelming majority of your monthly payment goes toward interest, not principal. You might be paying $3,000 a month, but in that first month, maybe only $600 or $700 is actually paying down your loan. The other $2,300? Poof, gone. Straight into the bank's pocket as their fee. We'll get into why and how this works later when we talk about amortization schedules, but for now, just burn this into your brain. The loan is front-loaded with interest. The bank always gets paid first. Okay, so we have principal and interest. That's the loan part of the payment. But what about the other two letters? T and I. Taxes and insurance. This is where a lot of first-time buyers get confused. They think, why am I paying my property taxes to my mortgage company? Can't I just pay the county myself? Let's talk about T taxes. This refers to your local property taxes. These are the taxes you pay to your city, your county, your school district to fund things like roads, schools, and fire departments. Here's why your lender cares so much about them. In the eyes of the law, the government's tax lien on your property is more important than the bank's mortgage lien. That means if you stop paying your property taxes, the county can foreclose on your home and seize it, wiping out the bank's investment entirely. The bank could lose all $400,000 they lent you. They are absolutely terrified of this. So, to protect their investment, most lenders require you to pay a portion of your annual property taxes to them with every single mortgage payment. They take that little slice of money, say $300, and they put it into a special savings account. This account is called an escrow account. Then, when the big annual property tax bill is due, they pay it for you on your behalf, using the money you've been saving up in that escrow account all year. It's forced savings designed to protect the bank. And the exact same logic applies to the final letter, I, insurance. This is your homeowner's insurance. This is the policy that protects the house against things like fire, hail, or a tree falling through the roof. Just like with taxes, the lender requires you to have this insurance. Why? Because if your house burns to the ground and you don't have insurance, you're left with a pile of ash, and the bank is left with a loan on an asset that is now worthless. They lose everything. So they force you to have insurance. And just like with taxes, they usually insist on collecting a portion of your annual insurance premium every single month. They put that money, say $100, into that same escrow account right alongside your tax money. And when your insurance bill is due once a year, they pay it for you from the escrow account. So let's put it all together. PITI. Your monthly payment is a combination of a slice of principal, a big slice of interest, a slice of your property taxes, and a slice of your homeowner's insurance. The bank bundles it all together into one single payment you make to them, and then they handle distributing the money for taxes and insurance from your escrow account. This total PITI payment is the true cost of your housing, and it's the number that the bank will use to determine if you can actually afford the house in the first place. The sticker price is one thing, but PITI is reality. Understanding this is the first most crucial step toward taking control of the entire process. So with the reality of PITI firmly in your mind, you're ready for the real first step in the home buying journey. And no, it's not scrolling through Zillow. It's not going to open houses. It's getting pre-approved for a loan. Now, you've probably heard two terms thrown around: pre-qualification and pre-approval. They sound similar, but they are worlds apart. Confusing them can lead to massive frustration and heartbreak down the road. A pre-qualification is a 10-minute phone call. It's a casual chat. You tell a lender your income and your debt off the top of your head, and they give you a rough, unverified estimate of what you might be able to borrow. It's a marketing tool. It's the equivalent of a store employee saying, "Yeah, you look like you could probably afford this." It's based on nothing but your own words, and in the eyes of a home seller, it's worth about as much as the paper it's printed on. A pre-approval, on the other hand, is the real deal. This is where the bank puts your financial life under a microscope. It's not a conversation. It's an investigation. You provide actual hard copy proof of everything you claim. Pay stubs, tax returns, bank statements, the works. An underwriter, a real human being whose entire job is to assess risk, meticulously reviews your file, and gives you a conditional commitment for a specific loan amount. Getting a pre-approval isn't just a box to check. It is your single greatest weapon in the home buying process. First, it transforms you from a window shopper into a serious buyer. Most real estate agents won't even take you to see homes without a pre-approval letter in hand, and sellers won't look twice at an offer without one. It signals that you have the financial backing to close the deal. Second, it gives you a rock-solid price ceiling. It eliminates the guesswork. You're no longer dreaming about million-dollar mansions if your pre-approval is for $400,000. This focus saves you an incredible amount of time and emotional energy. You can now hunt with precision, looking only at homes you know for a fact you can afford. So, what does it take to get through this financial gauntlet? You need to assemble your financial resume. The lender wants to see two things above all else: your ability to pay the loan back consistently, and your history of paying other debts back responsibly. First, you'll need proof of income. If you're a W-2 employee, this is pretty straightforward. You'll need your most recent pay stubs covering a 30-day period, and your W-2 forms from the last 2 years. The 2-year rule is important. Lenders want to see stability. If you just got a huge promotion, that's great, but they're going to average your income over a 24-month period to ensure it's consistent. For the self-employed, freelancers, or business owners, it's more intense. You'll need 2 years of full tax returns, both personal and business, and a year-to-date profit and loss statement. They're going to scrutinize every deduction to establish a reliable, average monthly income. Next, you'll need proof of assets. This means providing the last 2 to 3 months of statements for all of your accounts. Checking, savings, 401ks, brokerage accounts, you name it. They are looking for 2 things here. First, do you have enough cash for the down payment and the closing costs? And second, they're looking for the source of those funds. Lenders are legally required to source all large, non-payroll deposits. That $50,000 deposit that showed up last month from Aunt Carol? You'll need a signed gift letter from her stating that the money is a gift, not a loan that you have to pay back. They need to be sure your down payment isn't just another form of debt. Of course, they'll also need to see all your liabilities. They're going to pull a comprehensive credit report that lists every debt you have to your name. Car loans, student loans, credit cards, personal loans. Be prepared to explain any anomalies, like late payments or collection accounts. Honesty here is critical. Hiding a debt is a fool's errand. They will find it, and it will torpedo your application. And this brings us to the 2 titanic numbers that will ultimately decide your fate: your credit score and your debt-to-income ratio. Let's talk about your credit score. You might check your score on a free app and see a 750, but that's likely a consumer score, which isn't the same one lenders use. Lenders pull a specific mortgage credit report from all 3 major bureaus: Experian, Equifax, and TransUnion. They don't average the 3 scores. Instead, they typically use the middle score. So if your scores are 720, 740, and 760, they will use 740. This score is arguably the single most important factor in your mortgage application. It's a direct reflection of your reliability as a borrower. A higher score doesn't just increase your chances of getting approved. It directly impacts how much you pay. It determines your interest rate. A borrower with a 760 score might get an interest rate of 6.5%, while a borrower with a 680 score might be offered 7.25% for the exact same loan on the exact same house. That might not sound like a huge difference, but let's run the numbers. On a $400,000 loan, that seemingly small difference is over $300 a month. Every single month. Over the 30-year life of the loan, the person with the better credit score will pay over $110,000 less in interest. Let me repeat that, over $100,000. Your credit score isn't just a number. It's a direct discount or penalty on the biggest purchase of your life. The second magic number is your debt-to-income ratio, or DTI. This is the lender's stress test. It's a simple, brutal calculation that tells them what percentage of your monthly income is already spoken for by debt. There are 2 parts to it. The front-end ratio is your proposed new housing payment, that pity we talked about, divided by your gross monthly income, which is your income before taxes are taken out. Lenders generally want to see this number at or below 28%. But the one they care about even more is the back-end ratio. This is your total monthly debt, your new pity payment plus your car payment, your minimum credit card payments, your student loan payments, everything, divided by that same gross monthly income. For most conventional loans, lenders draw a hard line in the sand at 43%. If your total debt obligations, including your new house, exceed 43% of your pre-tax income, the alarm bells start ringing. To them, you're over-leveraged and a higher risk for default. So let's say you make $10,000 a month before taxes. Your proposed pity is $2,800. Your front-end DTI is 28%, right on the money. But you also have a $500 car payment and $700 in student loan payments. Your total monthly debt is now $2,800 plus $500 plus $700, which equals $4,000. Your back-end DTI is $4,000 divided by $10,000, which is 40%. You're in the clear. But if that pity was $3,200, your total debt would be $4,400, and your DTI would jump to 44%. Suddenly you've crossed the line. The bank will likely deny the loan or require you to look for a cheaper house. This DTI calculation is why a lender doesn't just care about how much money you make. They care about how much of that money is already promised to someone else. It's the ultimate affordability check. Once you've submitted all this documentation, and the lender has verified your income, assets, credit, and DTI, you'll receive that coveted pre-approval letter. It will state the maximum amount you're approved to borrow, what type of loan it is, and the projected interest rate. You are now officially a serious contender. You have your budget, you have your proof of funds, and you're ready to start the hunt. But getting the pre-approval is just winning the first battle. Now you have to choose your weapon, because the type of loan you get and the lender you get it from will shape your financial future for decades to come. Not all loans are created equal, and the fine print can make all the difference. So let's break down your arsenal. First, you have to decide who is going to forge this weapon for you. This is your lender, and they come in 4 main flavors. First, you have the big national banks. Think Chase, Wells Fargo, Bank of America, the giants. The advantage here is familiarity. You probably already have a checking or savings account with one of them. They're a known quantity, a massive, stable institution. But that size can be a double-edged sword. To them, you might just be another number in a very, very long line. Their process can be rigid, their underwriting guidelines strict, and they may not have the most competitive rates because, well, they don't have to. They have brand recognition. Going with a big bank is like choosing the default character in a video game, reliable, but maybe not optimized for your specific playstyle. Next up, you have credit unions. These are the local heroes, the community players. A credit union is a nonprofit, member-owned financial institution. That means instead of answering to shareholders, they answer to you. The result? Often you'll find better interest rates, lower fees, and a more personal, hands-on approach. They're more likely to look at the whole picture of you as a person, not just the numbers on a screen. The catch? You have to be a member to use them. Membership is usually based on where you live, where you work, or an organization you belong to. If you qualify, they are absolutely worth a look. Then you have the wild card, the mortgage broker. A broker isn't a lender. They're a matchmaker, a financial headhunter. You go to a broker, and they take your single application and shop it around to dozens of different wholesale lenders, many of whom you've never even heard of. Their job is to find the best possible loan for your specific situation. They can be fantastic for people with unique circumstances. Maybe you're self-employed or have a slightly bruised credit score. The broker knows which lenders specialize in those cases. The potential downside is that brokers are paid on commission. While regulations are in place to protect you, it's crucial to work with a reputable broker who puts your interests first, not their own paycheck. Finally, we have the new kids on the block, the direct or online lenders. Think Rocket Mortgage or Better.com. Their entire model is built on speed, technology, and convenience. You can get pre-approved on your phone while waiting for your coffee. They've streamlined the process, cutting out a lot of the traditional overhead, which can sometimes translate to competitive rates. The trade-off is often the human element. If you're someone who wants to sit down with a person and have your hand held through every step, a purely online experience might feel isolating and automated. But for a straightforward application and a desire for speed, they are a powerful option. Okay, so you've picked your champion, the bank, the credit union, the broker, or the online lender. Now for the main event, choosing your actual weapon. This is the loan type, and the one you choose will fundamentally change the rules of the game. The most common, the standard issue rifle of the mortgage world, is the conventional loan. This is a loan that is not insured or guaranteed by the federal government. To qualify, lenders are looking for a solid financial soldier. You'll typically need a credit score of 620 or higher, and a down payment of at least 3 to 5%. Now here's the fine print everyone talks about. If you put down less than 20% on a conventional loan, you will have to pay something called PMI, or private mortgage insurance. This is an extra fee tacked onto your monthly payment that protects the lender in case you default. It is nothing for you. It's the lender's insurance policy that you are forced to pay for. The good news? Once your loan balance drops to 78% of the home's original value, the lender is required to automatically cancel your PMI. It disappears. That's a key advantage. But what if your credit isn't perfect, or you don't have a huge down payment saved up? You need a different tool. Enter the FHA loan. This loan is insured by the Federal Housing Administration, which makes it less risky for lenders. Because the government is backing them up, lenders are willing to offer FHA loans to people with credit scores as low as 580 and a down payment of just 3.5%. This is the loan that opens the door to homeownership for millions of Americans. It's a fantastic gateway, but it comes with a significant cost. Remember PMI on conventional loans? FHA has its own version called MIP, or Mortgage Insurance Premium. And here's the brutal difference. For most FHA loans today, you pay that mortgage insurance for the entire life of the loan. It never goes away unless you refinance into a different type of loan. That 3.5% down payment looks great on day one, but that lifelong MIP can cost you tens of thousands of dollars over time. It's a powerful tool, but one with a permanent side effect. Next, for those who have served our country, there is a truly special option: the VA loan. Guaranteed by the U.S. Department of Veterans Affairs, this is a benefit earned through military service. And the benefits are incredible. The headline feature: 0 down payment. Not 3.5%, not 3%. 0. On top of that, there is no monthly mortgage insurance. This combination can save you a massive amount of cash up front and every single month. It is, by far, one of the best loan programs in existence. To be eligible, you need to be a veteran, active duty service member, or an eligible surviving spouse. There is a one-time funding fee, but it can often be rolled into the loan amount, and it's a small price to pay for the immense advantages this loan provides. Finally, there's a loan for the pioneers, the people looking to live outside the big city bustle, the USDA loan. This loan is backed by the U.S. Department of Agriculture to help encourage development in rural and suburban areas. And like the VA loan, it offers a 0 down payment option. The catch? It has 2 major restrictions. First, your income can't be too high. It's designed for low to moderate income families. Second, the property itself must be located in an eligible rural area. But rural is defined very broadly by the USDA. You'd be shocked to find how many small towns and suburban outskirts of major cities qualify. It's a niche weapon, but for the right person in the right place, it's a perfect fit. So you have your lender and you have your loan type: conventional, FHA, VA, or USDA. But there's one last critical choice. Is your weapon predictable? Or is it volatile? This is the difference between a fixed rate and an adjustable rate mortgage. A fixed rate mortgage is the bedrock of homeownership. It's a promise. The interest rate you lock in on day one is the exact same interest rate you will have on day 10,000. If your rate is 6.5%, it will be 6.5% when you make your first payment and 6.5% when you make your very last payment 30 years later. Your principal and interest payment will never, ever change. It is the definition of stability. It's like setting the thermostat in your house and knowing it will stay at that perfect temperature for 3 decades. You can budget with absolute certainty. The alternative is the adjustable rate mortgage, or ARM. An ARM is a gamble. It lures you in with a lower initial interest rate than a fixed rate mortgage, known as a teaser rate. You might see a 5-to-1 ARM, which means the rate is fixed for the first 5 years, but after that, it can change once every year for the rest of the loan's term. That change is tied to a specific market index. If market rates go up, your rate goes up and your monthly payment goes up. If they go down, your payment goes down. You're trading long-term stability for a short-term discount. So who takes this risk? Someone who is confident they will sell the house or refinance before that first adjustment hits. They plan to take advantage of the lower payments for a few years and get out before the storm arrives. But if your plans change, or if the market goes crazy, you could find yourself on a ship in a hurricane with a payment that becomes completely unaffordable. Choosing your lender, your loan type, and your term is the strategic core of this entire process. It's about matching the financial weapon to your personal circumstances, your risk tolerance, and your long-term goals. This isn't a one-size-fits-all decision. The best loan for your friend is not necessarily the best loan for you. You've done the reconnaissance. You've assessed the battlefield. You've chosen your lender and your weapon. You are ready, but now you have to prove you are worthy of wielding it. The next step is the deep dive, the full-body scan of your entire financial life, the official mortgage application. And the amount of paperwork, documentation, and scrutiny coming your way is enough to build a small house out of. This isn't just an application. It's a financial colonoscopy. It's the lender strapping you to a chair under a single bare light bulb and asking, "Where were you on the night of your last 3 overdraft fees?" They are about to go through your financial life with a fine-toothed comb. And the goal is to leave no stone, no receipt, no late-night pizza purchase unturned. Now, before you panic and think this is some cruel hazing ritual for aspiring homeowners, understand the why behind it. A lender is about to hand you, a person they've never met, a check for hundreds of thousands of dollars. It's likely the single largest investment they will ever make in you. They are betting their company's money that you are a reliable, stable, and trustworthy person who will pay them back, with interest, every single month for the next 30 years. To make that bet, they need to be absolutely certain. They need to know you better than your own mother. They need proof. And that proof comes in the form of a mountain of documents that validate every single number you put on that application. Think of it as building a case for yourself in the court of mortgage approval. Your loan officer is your attorney, but you have to provide all the evidence. This evidence generally falls into 4 main categories: identity, income, assets, and debts. First, the easiest part, identity. They need to know you are who you say you are. This is simple stuff. A copy of your driver's license or passport, your social security number. This is just to check the box and run the background checks required by law. It's the handshake before the interrogation begins. Next, and this is the big one, is your income. The lender's primary question is, does this person have a stable, verifiable, and likely to continue ability to earn money? For them, your paycheck is their security blanket, so you'll need to prove it. If you're a salaried employee, a W-2 employee, this is relatively straightforward. You'll typically need your last 30 days of pay stubs, showing your year-to-date earnings. You'll also need your W-2 forms from the past 2 years. The W-2 is the government's official record of what your employer paid you. By looking at 2 years' worth, the lender can see a history. Is your income stable? Is it going up? They love to see that. But what if you're self-employed? Or a freelancer? Or you get paid in commissions or bonuses? This is where it gets more complicated. The lender gets nervous when income isn't a predictable, bi-weekly deposit. To calm their nerves, you need to provide much more evidence. You're not handing over W-2s, you're handing over your last 2 years of full federal tax returns. Every single page, every schedule. They're going to look at your net income, not your gross. So that $100,000 year you bragged about? If you wrote off $60,000 in expenses to the lender, you only made $40,000. They will likely average your net income over the past 2 years to get a conservative, reliable number. They want to see a 2-year history of you successfully running your business and paying yourself. Anything less than that is a massive red flag. The third pillar is your assets. This is everything you own that has value. The lender wants to know 2 things. Do you have the cash for the down payment and closing costs? And do you have any money left over after that? That leftover money is called reserves. They want to see that you won't be flat broke on day 1 of homeownership. What if the water heater explodes a week after you move in? Reserves, typically measured in how many months of mortgage payments you could cover, show you have a cushion. To prove this, you will need your last 2 to 3 months of bank statements for every single account you have. Checking, savings, investment accounts, 401k statements, everything. And they will scrutinize these statements like a detective looking for clues. Every single page. Yes, even the blank ones. They are looking for something very specific. Large undocumented deposits. This is a concept called sourcing and seasoning. The lender needs to know where your down payment money came from. That's sourcing. And they need to see that it's been in your account for a while. That's seasoning, usually at least 60 days. Why? Because they need to make sure you didn't just get a secret, undocumented loan from your Uncle Vinny for the down payment. Because if you did, that's not really your money. It's another debt you have to pay back, which increases your risk. A sudden $10,000 deposit a week before you apply looks suspicious. That cash you've been stashing under your mattress for years? To a lender, it doesn't exist until it's been seasoned in a bank account. You can't just show up with a duffel bag of cash. Every dollar has to have a paper trail. If you received a gift from a family member for the down payment, that's usually okay. But it requires a formal gift letter, a paper trail from their account to yours, and proof that it is a true gift, not a loan. Finally, we have the 4th pillar, your debts. What do you owe and to whom? They already pulled your credit report during pre-approval, but now they're verifying it. They will cross-reference everything. That student loan payment, that car loan, the minimum payments on all your credit cards, they want to see it all. They will ask for statements if anything looks unclear. They're recalculating your debt-to-income ratio with a microscope, using the exact, verified numbers for your monthly obligations. This is the final piece of the puzzle that tells them how much of your verified income is already spoken for before you even pay your new mortgage. Once you've gathered this small library of your life's financial history, you'll formally fill out the Uniform Residential Loan Application, or what insiders call the 1003. It's a standardized form where you officially state your income, list your assets, and confess your debts. You'll sign it, and at the bottom you will attest, under penalty of federal law, that everything you have said and provided is true. Lying on a mortgage application isn't just a bad idea. It's a felony. You hit submit. You email the gigabytes of scanned documents. And your file, this perfect digital recreation of your financial soul, gets sent to the person who actually makes the decision. Not the loan officer you've been friendly with. It goes to the underwriter. The underwriter is the judge. They are the gatekeeper. They don't know you, and they don't care about your story or how much you love the house. Their job, their only job, is to protect the lender's money. They are a human risk assessment algorithm. They take all the evidence you've painstakingly provided, and they put it on trial. They verify your employment one more time. They comb through your bank statements looking for that one weird deposit you forgot to explain. They rerun the numbers on your DTI. They are looking for any inconsistency, any red flag, any reason to say no. Your loan officer's job was to help you build the best possible case. The underwriter's job is to try and poke holes in it. They are the final boss of this level of the game. And as your application sits in their queue, a deafening silence begins. The waiting is the hardest part. Every email notification makes your heart jump. Every phone call could be the one. And what comes back from the underwriter is rarely a simple yes. What usually comes back is the next critical stage in this process, a conditional approval. And those conditions can sometimes feel like a whole new set of impossible trials. So what exactly are these conditions? Think of it like this. The underwriter has looked at your file and said, okay, on paper this looks pretty good. I'm 90% sure we can give you this loan. But I need you to prove a few more things to get me to 100%. It's a yes, but a yes if. And each one of those ifs is a hurdle you have to clear before they'll release the money. This is where the process can get intensely personal and, frankly, incredibly frustrating. Because the underwriter's job is to question everything. Let's say you had a big cash deposit into your bank account 3 weeks ago. Maybe your grandma gave you $5,000 to help with the down payment. To you it's a sweet, loving gesture. To an underwriter it's a giant flashing red light. They see that deposit and their first thought isn't, what a nice grandma. Their first thought is this an undisclosed loan? Because if grandma expects that money back, that's a debt. And that debt changes your entire financial picture, your debt-to-income ratio. So they issue a condition. Source the large deposit in the checking account ending in 4-5-6-7. Now it's on you to prove it was a gift. This means getting your grandma to sign a legal document called a gift letter, a sworn statement that says, yes, I gave my grandchild this money, it is a true gift, and I have no expectation of being repaid. You'll also need to provide a paper trail, showing the money leaving her account and entering yours. For many people, this is an awkward conversation. You're essentially asking a loved one to help you prove to a stranger that their kindness wasn't a secret, shady loan. This is the level of detail we're talking about. Every single dollar has to have a story, and you need the documents to prove it. Another common condition is the verification of employment, or VOE. They already did this once when you were pre-approved, but that was weeks, maybe even a month ago. In the world of lending, a month is an eternity. Are you still employed? Are you still making the same amount of money? They need to know. So, they will call your employer sometimes just days before you're supposed to get the keys for a final confirmation. This can be a nail-biting experience. What if your HR contact is on vacation? What if your boss doesn't pick up the phone? The entire multi-$100,000 transaction can grind to a halt, waiting for a simple phone call to go through. But the biggest, most dreaded condition of them all, the one that makes both buyers and sellers sweat, is the appraisal. The bank is about to lend you an enormous sum of money, secured by this one asset, the house. They need to be absolutely certain that the asset is actually worth what you've agreed to pay for it. They are not going to lend you $400,000 for a house that's only worth $350,000. If you default on the loan, they'd be out $50,000 right off the bat. So they hire an independent third-party appraiser. This person has one job: to provide an unbiased, professional opinion of the property's fair market value. They are the bank's eyes and ears. They'll walk the property, measure the square footage, count the bedrooms and bathrooms, assess the condition of the roof, the HVAC system, the foundation. They'll take pictures of everything. Then they'll go back to their office and pull up comps. Comparable, recent sales of similar homes in the same neighborhood. They'll make adjustments. This house has a pool that one doesn't, so add some value. This house backs up to a busy road that one backs up to a park, so subtract some value. It's a complex process of data analysis and professional judgment that results in a single powerful number: the appraised value. Everyone holds their breath waiting for this report. The best-case scenario is that the house appraises for exactly what you offered or even more. If you offered $400,000 and it appraises for $410,000, great. Everyone is happy, the bank is secure, and you walk in the door with $10,000 in instant equity. But the nightmare scenario is when the appraisal comes in low. You offered $400,000, but the appraiser says it's only worth $380,000. This creates what's called an appraisal gap, and it's a crisis point in the transaction. The bank will only lend you money based on the lower of the two values, the purchase price or the appraised value. So, they will only give you a loan based on a $380,000 home. That $20,000 difference is now your problem to solve. You now have only three options. 1. You can go back to the seller hat in hand and try to renegotiate. You say, look, an independent expert says your house is only worth $380,000. You need to lower the price by $20,000. In a buyer's market, they might agree. But in a competitive market, the seller might just laugh and say, no thanks, I'll sell it to the next person in line. 2. You can come up with the $20,000 out of your own pocket. You pay the extra cash at closing to cover the gap. This is on top of your down payment and your closing costs. For many people, this is simply not possible. They've already scraped together every last penny they have. 3. You walk away from the deal. Most contracts have an appraisal contingency that allows you to back out and get your earnest money back if the home doesn't appraise. But it's heartbreaking. You've already invested so much time, money, and emotional energy. You've pictured your life in that house. And now, because of one person's opinion of value, it's all over. While you're navigating all of this, there's another team of detectives working in the background on another critical condition: the title search. The title is the legal concept of ownership. A clean title means the seller is the undisputed owner and has the absolute right to sell the property to you. But titles can get messy. Over decades, properties can accumulate problems, like clouds on the horizon. These are called encumbrances or defects. A title company will send researchers to dig through dusty public records, deeds, and court filings, sometimes going back 100 years or more. What are they looking for? They're looking for ghosts. A long-lost heir who technically inherited a 1/4 share of the property in 1952 and never signed it away. A contractor who put a mechanic's lien on the house in the 90s because they were never paid for building the deck. An unpaid property tax bill from a decade ago. A neighboring property that has a legal right, an easement, to use your driveway. Any of these things could jeopardize your ownership. You could buy the house only to have that contractor show up a year later demanding the $15,000 he's owed. And by law, he could have a claim against your new home. This is why the lender's condition is that you must have a clear title, and you must purchase title insurance. Title insurance is a unique policy. Unlike car or health insurance that protects you from future events, title insurance protects you from the past. It's a one-time fee you pay at closing, and it insures you and the lender against any of these historical ghosts coming back to haunt you and make a claim on your property. Clearing all these conditions, the gift letters, the employment checks, the appraisal, the title search, is an exhausting marathon. You're sending emails, making phone calls, uploading documents at 10 o'clock at night. But then one day you get an email from your loan officer. The subject line might just be 2 words: final approval. Or even better, the 3 most beautiful words in the entire home buying process: clear to close. This is it. The moment of triumph. The underwriter is satisfied. All the conditions have been met. The bank has officially, finally, and fully committed to giving you the loan. The finish line is in sight. All that's left is to sign the final papers and get the keys. You breathe the biggest sigh of relief of your life. You've done it. You've conquered the gauntlet. So you celebrate. You go out and finance that beautiful new sectional sofa for the living room you've been dreaming about. You open a store credit card to buy a brand new, top-of-the-line refrigerator. Maybe you even decide it's time to trade in your old car for a new one to put in your new garage. And in doing so, you may have just made the single biggest, most catastrophic mistake of the entire process. A mistake that could kill the entire deal just hours before it's supposed to be final. To understand why buying that car is a deal-killing, soul-crushing financial atom bomb, you have to understand what's been happening in the background ever since you signed that purchase agreement. While you've been busy scheduling movers and picking out paint colors, your loan file has been on a journey to the desk of the most important person you will never meet: the underwriter. The underwriter is the final boss of the mortgage world. They are not a salesperson. They are not your friend. They don't work for you. They work for the lender. And their one and only job is to protect the lender's money. They are a financial detective, a risk analyst, and a human lie detector all rolled into one. They are given your entire life on paper. Every pay stub, every bank statement, every debt you've ever had. And their job is to scrutinize it, poke holes in it, and decide if you are an acceptable risk. They are the person who gives the final yes or no on hundreds of thousands of dollars. When your loan officer gave you that pre-approval letter, that was based on their initial review. They collected your documents and ran the numbers through an automated system, which gave a preliminary thumbs up. But that's not the real approval. That's just permission to proceed to the main event. Now the underwriter takes that same file and goes through it with a fine-tooth comb, verifying every single detail manually. This is the stage known as underwriting, and it is where more deals go to die than any other. The underwriter is looking for two main things: your ability to repay the loan, and your willingness to repay the loan. Your ability is proven by your income and your assets. Is your income stable? Can we verify it directly with your employer? Do you have enough cash in the bank for the down payment and closing costs, plus some reserves left over? Your willingness is proven by your credit history. Do you have a track record of paying your debts on time? So the underwriter starts digging. They send a verification of employment, or VOE, to your HR department. This isn't just a phone call. It's an official form that asks your employer to confirm your start date, your title, your salary, and the probability of your continued employment. They want to make sure the pay stubs you provided are real, and that you didn't just get a temporary raise to qualify for the loan. Next, they look at your bank statements, and they don't just glance at the balance. They are hunting for red flags. They see a recent large deposit of $10,000 that wasn't from your payroll. Where did that come from? To them, an undocumented large deposit isn't a gift. It's a secret loan. It's a potential debt that you haven't disclosed, which would affect your ability to pay the mortgage. So they issue what's called a condition. This is a crucial part of the process. The underwriter will likely come back with a list of conditions, which are basically just requests for more information or documentation. This can feel incredibly frustrating. You feel like you've already given them a mountain of paperwork, and now they want more? They might want a letter of explanation, or locks, for that large deposit. If it was a gift from your parents, they'll want a signed gift letter from your parents stating the money is a true gift and not a loan, and they'll want to see the bank statement from your parents' account showing the money being withdrawn. Yes, they will literally ask to see your parents' bank statements. They are that thorough. They might see a recurring payment to an unknown entity and ask what it is. Is it an undisclosed alimony payment? A personal loan to a friend? They'll want documentation for everything. They'll want every single page of your bank statements, even the blank ones, to ensure you're not hiding anything. This back and forth can take days, sometimes weeks. Your loan officer acts as the middleman, relaying the underwriter's requests to you and submitting your new documents back to them. Once you've satisfied all their questions, the underwriter gives you what's called a conditional approval. This is a huge milestone. It means the underwriter has reviewed your file and is saying, "I will approve this loan if you can meet these final conditions." These are usually simpler things, like providing proof of homeowner's insurance for the new property or evidence that you've paid off a small collection account. After you clear those last few hurdles, you finally get the 3 magic words every homebuyer is desperate to hear. Clear to close. This is it. The green light. The underwriter has officially signed off. Your loan is fully approved. The lender is ready to wire the money. The finish line is in sight. You are maybe 72 hours away from getting the keys to your new home. And this is where we come back to that brand new car sitting in your driveway. You see, the underwriting process isn't truly over until the moment the money is sent. In that final 24 to 72 hours before closing, the lender does one last final check. They do a soft pull on your credit report. It's not a full-blown inquiry that dings your score, but it's enough to see if any new accounts have been opened or if any new debt has appeared since your initial application. They also often do one last verbal verification of employment, calling your boss one last time to ask the most terrifying question in real estate. Is John Doe still employed with your company? If you quit your job the day before closing, the deal is dead. But you didn't quit your job. You did something you thought was harmless. You bought a car. So the lender does their final soft credit pull, and suddenly, a brand new loan for $40,000 pops up on your report. A loan that wasn't there a week ago. A loan that comes with a $600 monthly payment. Alarms go off in the underwriting department. the entire closing process screeches to a halt. Remember that debt-to-income ratio we talked about? That magic number that had to be below 43%? Let's say yours was sitting at a comfortable 41%. You were safely under the limit. But now you've just added a $600 monthly payment to your debt column. The underwriter has to recalculate everything. Just hours before closing, they plug that new $600 payment into the formula. And suddenly, your DTI jumps from 41% to 46%. You are now over the limit. You no longer qualify for the loan. The clear to close is revoked. The deal is off. All because of a car. It could be a car. It could be a living room set from a furniture store financed with a new credit card. It could be co-signing a loan for your cousin. Any new debt can do this. The period between your loan application and your closing day is a financial quiet period. You need to act like you're in a witness protection program for your finances. Don't open new credit. Don't close old credit. Don't move large sums of money around. Don't change jobs. Don't do anything that changes the financial picture you originally presented to the lender. That pre-approval was a snapshot of you on a specific day. The underwriter's job is to make sure that snapshot is still accurate on closing day. By buying that car, you changed the picture, and in doing so, you invalidated the entire approval. Now your frantic loan officer is on the phone, trying to salvage the deal. Can you return the car? Almost never. Can you pay off another debt to lower your DTI? Maybe, but do you have $20,000 in cash sitting around? Probably not, since it's all earmarked for your down payment. The sellers are angry, the moving truck is booked, and your dream home is slipping through your fingers. This isn't just a scary story. It happens every single day. People get excited. They get their clear to close and think they're done. They go out and finance $5,000 worth of new appliances for the kitchen they don't even own yet, and the whole thing implodes. So you've survived the underwriting gauntlet. You've avoided the catastrophic mistakes. You have your official final, clear to close. What happens now? You are about to be introduced to the most important document you've seen yet. A document that will finally reveal the exact down-to-the-penny amount of cash you need to bring to the closing table. And for most people, that number is a lot bigger and a lot more confusing than they ever expected. This document is called the Closing Disclosure, or the CD. And it's not just a piece of paper. It's the financial blueprint of your entire transaction. It's the final legally binding summary of exactly what you're paying, who you're paying, and what you're getting. For years, homebuyers would walk into a closing, see these numbers for the very first time, and feel immense pressure to just sign on the dotted line, confused and overwhelmed. It was a terrible system. But then, a rule was created called the TILA-RESPA Integrated Disclosure Rule, or TRID. You don't need to remember that name. What you need to remember is what it does for you. It's often called the Know Before You rule, and it mandates that your lender must give you this closing disclosure at least 3 full business days before your scheduled closing date. This isn't a suggestion, it's the law. This 3-day window is your golden opportunity. It's your time to review, to question, and to understand without a notary staring at you, tapping their pen on the table. So let's use that time. Let's demystify this 5-page monster. Because the moment you understand it, the fear disappears, and it transforms from a source of anxiety into a tool of empowerment. The first thing we need to address is the biggest myth about closing on a house. The idea that the only cash you need is your down payment. You've been saving for it, you've been tracking it, it's the number you've had in your head for months. If you're buying a $400,000 house with 20% down, you're thinking, okay, I need $80,000. But when you get your closing disclosure, the cash to close number might be $86,000 or $88,000 or even more. And that's where the panic sets in. Where did this extra $8,000 come from? It came from something called closing costs and prepaids. And your CD is going to show you exactly where every single one of those dollars is going. Let's start with page 1. This page is the high-level summary. It's designed to be a quick snapshot. At the very top, you'll see the loan terms, your interest rate, your monthly principal and interest payment, and whether your loan has a prepayment penalty or a balloon payment, which for most standard mortgages, the answer should be no. This section should look incredibly familiar. It should be an exact match to the final loan estimate you agreed to. If your interest rate is suddenly different, that's a giant red flag. Then you'll see a section called Projected Payments, which breaks down your total estimated monthly payment, your PITI, principal, interest, taxes, and insurance. It shows you not just what you'll pay in the first year, but how it might change over time as property taxes and homeowners insurance premiums go up. And then at the bottom of the page, the main event, the costs at closing summary. This is where you see that final cash to close number. But it does something crucial, it shows you the math. It starts with your total closing costs, adds your down payment, subtracts any deposits you've already paid, like your earnest money, and subtracts any credits the seller has agreed to give you. The result is that final all-important number. But that's just the summary. The real story, the details of that extra $8,000 in our example, is on page 2. Page 2 is the heart of the closing disclosure. It's an itemized receipt for the biggest purchase of your life. It's broken down into 2 main columns: loan costs and other costs. Let's look at loan costs first. These are all the fees associated with getting the actual mortgage. Think of this as what you're paying the lender and their partners to create your loan. You'll see a line for origination fees. This might be a flat fee or a percentage of the loan amount, often called points. This is the lender's core profit for doing the deal. Below that, you'll see a list of services you couldn't shop for. These are services the lender requires and chooses the provider for, like the appraisal fee, the credit report fee, and the flood certification fee. The prices for these services should be very close, if not identical, to what was on your loan estimate. By law, they can't change much. Next, you'll see a section for services you could shop for. This is where things like the title search, the lender's title insurance policy, and the settlement or closing fee live. Your lender gave you a list of preferred providers for these services, but you technically had the right to choose your own. If you went with their recommendation, again, these costs should align closely with your loan estimate. So that's the first half of your closing costs, the fees to create the loan. But then there's the second column, other costs. This is where the mystery is often solved. This column includes all the other expenses required to make the home officially yours. The first thing you'll see is a big one: taxes and other government fees. This is the fee the county or state charges to record your deed and mortgage, making you the official public owner of the property. It's unavoidable. And then we get to the section that causes more confusion than any other: prepaids. This is not a fee. You are not paying someone for a service. You are paying for something in advance. You'll see a line for your homeowner's insurance premium. You're typically required to prepay the entire first year's premium at closing. So if your insurance is $1,200 a year, that's $1,200 you need to bring to the table. Next, you'll see prepaid mortgage interest. This one always trips people up. Your first mortgage payment isn't due on the first of the next month. It's usually due the month after that. So if you close on May 15th, your first payment isn't due June 1st, it's due July 1st. But that July 1st payment only covers the interest for the month of June. So what about the interest from May 15th to May 31st? You have to pay for that at closing. It's the daily interest for the remaining days in the month you close. The later in the month you close, the smaller this number will be. And then comes the final and often largest piece of the puzzle: the initial escrow payment at closing. This is the big one. Your lender is going to set up a special savings account for you, called an escrow account. Every month, as part of your total mortgage payment, you'll pay a little extra. Typically 1/12 of your annual property tax bill and 1/12 of your annual homeowner's insurance premium. The lender holds this money for you in the escrow account, and when those big bills come due once or twice a year, the lender pays them on your behalf. It's a fantastic system that prevents you from being hit with a massive unexpected bill. But here's the catch. That account can't start at zero. The lender needs a cushion. They need to collect a few months' worth of those payments from you up front at closing to seed the account. The law allows them to collect enough to make the next payment, plus a cushion of up to 2 months' worth of payments. So, if your property taxes are $6,000 a year and your insurance is $1,200, that's $7,200 a year, or $600 a month. The lender might need to collect 3, 4, or even 5 months of that at closing. That's another $2,400 to $3,000 right there. And suddenly it all adds up. The loan origination fee, the appraisal, the title insurance, the government recording fees, plus the full year of prepaid homeowner's insurance, plus the prepaid daily interest, plus the initial seed money for your escrow account. That's where the extra $8,000 came from. It wasn't a hidden fee. It was the real total cost of closing, a combination of service fees, prepaid expenses, and escrow reserves. This is why your 3-day review period is so critical. You need to sit down with your closing disclosure and your last loan estimate side by side. Go line by line. Are the numbers in the loan cost section the same or very close? If not, why? Is your interest rate correct? Is your loan amount correct? Did they properly credit you for your earnest money deposit? Are there any fees you simply don't recognize or understand? Don't be afraid to pick up the phone and call your loan officer. Ask them to walk you through it. A good loan officer will be happy to explain every single line item until you are 100% comfortable. This is their job. If you find a legitimate error, maybe they forgot to include a seller credit or misspelled a name, it needs to be corrected immediately. This could trigger a new 3-day waiting period, so it's vital to get it right. Once you've reviewed every line, once you understand where every single dollar is going, and once you've confirmed that final cash to close number, you'll get final instructions from the title or settlement company. They will tell you the exact amount down to the penny and give you wiring instructions. You'll go to your bank and authorize a wire transfer for that amount. And with that, the money is on its way. The paperwork is finalized. You've conquered the closing disclosure. There is now only one thing left to do. Show up, sign your name, and get the keys to your new home. This is it. The day you've been working towards for months. It's called closing day. And it's the final formal step in turning a house into your home. You'll walk into a conference room, likely at a title company or an attorney's office, and feel a strange mix of excitement and nervousness. This is the moment where everything becomes real. So, who's at this final meeting? Let's set the scene. First, there's you, the buyer. You are the star of the show. You'll probably have your real estate agent with you, acting as your guide and advocate, there to answer any last-minute questions and make sure everything is in order. Across the table, you might see the sellers and their agent, though in many cases the sellers pre-sign their documents, so it might just be their representative. But the most important person in the room, the one running the entire meeting, is the closing agent. This person goes by many names depending on your state. They could be a title agent, an escrow officer, or a real estate attorney. Their job is to be an impartial third party. They don't work for you and they don't work for the seller. They work for the transaction itself. Their mission is to ensure that every single document is signed correctly, every dollar is accounted for, and that the ownership of the property is transferred legally and cleanly from the seller to you. They are the conductor of this financial orchestra. The closing agent will greet you, offer you a seat, and then gesture towards a stack of papers on the table in front of you. A stack so thick it looks like the manuscript for a novel. This is what you're here for. This is the part that intimidates everyone. But it doesn't have to, because once you understand the purpose of the main documents, the whole pile becomes much less scary. You're about to sign your name more times in the next hour than you have in the past year. So let's break down the heavyweight champions of this paperwork mountain. The very first and arguably the most important document you'll sign is the promissory note. This one is simple, direct, and powerful. The promissory note is your IOU to the lender. It is your personal, legally binding promise to repay the loan. It spells out the total amount you borrowed, the interest rate, your monthly payment amount, the dates those payments are due, and where you need to send them. It also clearly states the penalties for late payments and what happens if you default on the loan entirely. When you sign this piece of paper, you are creating the debt. There's no house attached to this document, no property description. It's a straightforward financial contract between you and the bank. If you were just borrowing money from a friend to buy a car, a promissory note is all you'd need. But for a mortgage, the bank needs more than just your promise. They need security. And that brings us to the second heavyweight document. This is the mortgage, or in many states, the deed of trust. While people use the word mortgage to describe the whole loan, the mortgage is actually a specific document that secures the promissory note. If the promissory note is your promise to pay, the mortgage is the collateral for that promise. Think of it like this: you go to a pawn shop and ask for a $100 loan. The shop owner says, "Sure, but I need you to leave your expensive watch with me. If you pay me back, you get your watch back. If you don't, I get to keep and sell the watch to get my money back." In this analogy, the promissory note is your verbal promise to pay back the $100. The watch is your house. And the mortgage document is the legal agreement that gives the pawn shop, the lender, the right to take your watch if you fail to pay. This document is what ties your loan debt directly to your property. It gives the lender a security interest in your home and spells out their right to foreclose, to take possession of and sell the property, if you don't uphold your end of the deal laid out in the promissory note. It's the document that makes the lender feel safe enough to give you hundreds of thousands of dollars. You are officially pledging your house as collateral. Next up, you'll see a familiar face. the final closing disclosure. You've already reviewed this, but now you're signing the official final version. Your signature here is your legal acknowledgement that you have received, understood, and agreed to all the costs and terms of the loan. This is your last chance to see all the numbers in black and white before they become permanent. It's the final receipt for the biggest purchase of your life. Then comes the document that actually makes you a homeowner, the deed. A deed is a legal instrument that transfers ownership of real estate. The seller signs what's called a warranty deed, which essentially says, "I am the rightful owner of this property. There are no hidden claims or liens against it that I know of, and I am now transferring my ownership to you." This is the piece of paper that legally moves the property from their name into your name. The closing agent's job is to make sure this deed is properly executed and, crucially, recorded with the county government. Recording the deed is what makes your ownership part of the public record, protecting you from any future claims that someone else owns the property. You'll also sign an initial escrow disclosure statement. Remember escrow? That special account for your property taxes and homeowner's insurance? This document breaks down exactly how much the lender will collect from you each month for that account, and how they'll pay those bills on your behalf throughout the year. It's a detailed forecast of your escrow account for the next 12 months, ensuring transparency. After those big ones, you'll face a flurry of other forms. Affidavits where you swear that you are who you say you are, that you haven't taken on any new secret debt since you applied, and that you intend to occupy the property as your primary residence. You'll sign IRS forms like the W-9. You'll sign documents acknowledging who will be servicing your loan. That's the company you'll actually send your payments to. Page after page, signature after signature. Your hand will start to cramp. You'll start to wonder if it will ever end. The closing agent will patiently guide you, saying sign here, initial here, date here. Feels repetitive, almost robotic. But every single signature has a purpose. Every line is a checkbox being ticked in a long and complex legal and financial process. Finally, after the last page is signed, the closing agent will take the entire stack, review every signature, and make copies. While they do this, the final pieces of the puzzle are falling into place behind the scenes. The agent confirms with your lender that all documents are signed correctly. The lender then gives the final authorization to release the funds from your loan. This is called funding. Your down payment and closing cost money that you wired earlier is combined with the lender's loan money in the title company's escrow account. The closing agent then disburses all that money. They pay off the seller's remaining mortgage if they had one. They pay the seller their profits. They pay both real estate agents their commissions. They pay the appraiser, the title insurance company, and any other third parties. They are the central hub, ensuring everyone involved in the transaction gets paid exactly what they are owed, down to the penny. Once all the money is sent out and the deed is sent to the county courthouse to be officially recorded, the closing agent will turn to you and say the magic words. Congratulations, you are funded and recorded. The home is officially yours. And then it happens. The moment that makes it all worth it. The seller's agent or the closing agent will slide a small, jangling object across the table. The keys. You pick them up. They feel heavy, substantial. This isn't just a piece of metal. It's the key to your front door. The key to your future. The key to your home. All the stress, the paperwork, the waiting. It all melts away in this one single triumphant moment. You did it. But that feeling, that triumphant moment, it doesn't last forever. It changes. It evolves into something quieter, something deeper. The first night in your new home is surreal. Every creak of the floorboards is a new sound to learn. The way the morning light hits the kitchen counter is a discovery. You spend the first few weeks unpacking boxes, ordering pizza to eat on the floor, and arguing good-naturedly about where the sofa should go. This is the honeymoon phase of homeownership. You're not just living in a house. You're creating a home. And then, about 2 or 3 weeks in, it arrives. It's sitting in your new mailbox, nestled between a takeout menu and a coupon for a local car wash. It's a plain white envelope, but it feels heavier than the rest. It's from your mortgage lender. This is it. Your first mortgage statement. Suddenly, it all becomes real in a completely new way. This isn't a bill for rent that disappears into a landlord's pocket. This is the first payment on the largest, most significant investment of your life. You open it up, and you're met with a wall of numbers and acronyms. Hey, escrow balance, principal, interest. It can feel like you're trying to read a foreign language. But understanding this single piece of paper is the key to understanding the next 15 or 30 years of your financial life. So let's break it down right here, right now. The first thing you might notice is the due date. You probably closed on your home sometime in the middle of the month, but your first payment isn't due on the 1st of the next month. It's usually due on the 1st of the month after that. Why the gap? Remember all that paperwork you signed at closing? One of those pages was for prepaid interest. You essentially paid the interest for the remaining days of the month you closed in. So if you closed on June 15th, you paid the interest from June 15th to June 30th right there at the closing table. Your first official mortgage payment due August 1st is actually paying for the month of July. Mortgages are paid in arrears, meaning you pay for the month you've just lived in, not the one you're about to start. Now let's look at the big number. The total monthly payment. This isn't just the loan repayment. For most people, it's a bundle of 4 different things famously known as PITI: principal, interest, taxes, and insurance. Let's start with the P and the I, principal and interest. This is the core of your loan. Principal is the actual amount of money you borrowed, the big number, the sticker price of your dream. Interest is the fee you pay the bank for the privilege of borrowing that money. Here's the critical part to understand, the part that shocks most new homeowners. In the beginning of your loan, your payment is almost all interest. Think of it like this. Imagine you're paying a giant 30-year-long rental fee to the bank for using their money. In the early years, the bank wants to get its fee paid first. So when you make that $1,000 payment towards principal and interest, you might be horrified to see that only $100 of it actually went to reducing your loan balance. The other $900, that was interest. It went straight to the bank. It can feel defeating. It can feel like you're running on a treadmill, putting in all this effort just to stay in the same place. But this is the nature of an amortization schedule. It's a fancy term for a simple but brutal reality. The loan is front-loaded with interest. However, with every single payment you make, that balance shifts ever so slightly. The next month, maybe $101 goes to principal. The month after, $102. It's a slow, grinding process, but a snowball is rolling downhill. Over years, the amount going to principal grows and the amount going to interest shrinks until, in the final years of your loan, the tables have completely turned. Your payments are almost entirely principal, and you're just wiping out the last little bit of interest. Seeing this breakdown on your statement each month isn't just a financial update. It's a progress report on a marathon. Okay, so that's principal and interest. But what about the T and the I? Taxes and insurance. This is where things get even more interesting, and where a crucial new player enters the scene. The escrow account. Your city and county need money to run things: schools, roads, fire departments. They get that money by charging you property taxes. And your lender, who has a massive financial stake in your house, needs to know that if it burns down, there's an insurance policy to cover the loss. They require you to have homeowner's insurance. Now, the lender has a very legitimate fear. What if you, the happy new homeowner, forget to pay your $1,000 property tax bill? Or what if you let your insurance policy lapse? If the county forecloses on your house for unpaid taxes, or if your uninsured house is destroyed in a fire, the bank's investment, their collateral, goes up in smoke. They can't let that happen. So, they create something called an escrow account. Think of it as a mandatory protected savings account that the lender manages for you. It's a brilliant, if slightly paternalistic system. Here's how it works. The lender estimates what your total property tax bill and your total homeowner's insurance premium will be for the entire year. Let's say it's $3,600 for taxes and $1,200 for insurance. That's $4,800 a year. They divide that by 12, which comes out to $400 a month. This $400 is the T and I portion of your PITI payment. Every month, when you send in your total payment, the lender schemes that $400 off the top and deposits it into your escrow account. The rest goes toward your principal and interest. You don't even see it happen. You just make one single, predictable payment. Then, when your big property tax bill is due, or your annual insurance premium comes up, the lender pays it for you automatically out of your escrow account. You don't have to worry about saving up for a massive once-a-year bill. The lender takes care of it, protecting both you and themselves. At closing, you actually pre-funded this account with a few months' worth of payments to give it a cushion. And once a year, the lender will do an escrow analysis. They'll look at whether your property taxes or insurance premiums went up or down. If they went up, your escrow account might have a shortage. This means you didn't put enough in over the year to cover the new, higher bills. So, your lender will typically increase your monthly mortgage payment for the next year to cover that shortage and account for the higher future costs. It's a painful letter to get, But it's not the bank raising your interest rate. It's the cost of taxes and insurance changing. Conversely, if your costs went down, you could have an overage, and the bank will send you a check for the difference. Feels like a surprise bonus. So, when you look at that statement, you see the full picture. You see the portion that's fighting the long war against your loan balance, the principal and interest. And you see the portion that's automatically handling your responsibilities as a homeowner, the taxes and insurance flowing through your escrow account. For some, there might be a fifth letter in this alphabet soup. M for mortgage insurance or PMI. If you put down less than 20%, this is an extra fee that also gets bundled into your payment, protecting the lender in case you default. It's pure insurance. It doesn't build you any equity. But the good news is, once you've paid down your loan to about 80% of the home's value, you can request to have it removed, and your monthly payment will drop. This monthly payment becomes the new rhythm of your life. It's the financial heartbeat of your home. It's no longer just a transaction. It's an act of creation. Every check you write, every online payment you submit, is a brick being laid in the foundation of your financial future. You're not just paying a bill. You are slowly, methodically transforming a massive debt into your single greatest asset. You are buying your freedom one month at a time. You've made it through the chaos of the hunt, the war of bidding, the gauntlet of underwriting, and the triumph of closing. Now you've settled into the steady, predictable rhythm of ownership. This is the new normal. But here's the question that smart homeowners start to ask. Does it have to be? Is this 30-year path the only path? Once you're locked in, are you stuck with this payment, this interest rate, this timeline for the next 3 decades? Or are there ways to change the game? Are there levers you can pull and strategies you can use to pay it off faster, save tens of thousands of dollars, and turn your home into a true wealth-building machine? The answer is a resounding yes. And understanding how to do that, well, that separates a simple homeowner from a savvy investor. Let's start with the single most important document you'll receive after closing: your amortization schedule. It looks harmless enough. It's just a long table of numbers showing every single payment you'll make for the next 360 months. But hidden in plain sight is the secret to how banks make almost all their money, and it's the key to your financial freedom. See, a mortgage is what's called front-loaded with interest. Imagine your 30-year loan is a mountain you have to climb. For the first 10 to 15 years, you're not really climbing up, you're just paying the mountain for the right to climb it later. Almost every dollar you send to the bank in those early years is pure interest. Your first payment on a $400,000 loan might be $2,400, but guess how much of that actually reduces your loan balance? Maybe $500. The other $1,900? Poof, gone. Straight into the bank's pocket. You're essentially renting money, and the rent is incredibly high at the beginning. This is the system. It's designed so that even if you sell the house in 7 years, the bank has already collected a massive chunk of its total profit from you. But what if you could hack this system? What if you could skip the long, slow, interest-heavy slog and start attacking the real debt, the principal, from day one? You absolutely can. And it's simpler than you think. This brings us to the first and most powerful strategy: making extra payments. It sounds boring, but the impact is electrifying. Let's stick with that $400,000 loan at a 6% interest rate. Your standard principal and interest payment is about $2,400 a month. If you just make those payments for 30 years, you will pay a staggering $503,000 in interest alone. That's more than the cost of the house itself. Now, what happens if you decide to add just $100 extra to your payment each month? You find it by cutting one streaming service, packing lunch a few more times, whatever it takes. $100. Feels like a drop in the ocean. But because that extra $100 is applied directly to the principal, it doesn't just pay off that $100 of the loan. It eliminates all the future interest that $100 would have accrued, month after month, for years and years. By adding just $100 a month, you would pay off your mortgage 4 years and 5 months early. And the savings? You would save over $76,000 in interest. Think about that. You paid an extra $25,900 over the life of the loan to save over $76,000. That's an incredible return on your money, and it's completely risk-free. What if you could swing $200 extra a month? You'd save over $131,000 and be mortgage-free 7.5 years sooner. This isn't a trick. It's just math. Math the bank is hoping you never do. The second strategy is a clever way to automate this process: the bi-weekly payment plan. You've probably heard of this. Instead of making one monthly payment, you make a half payment every 2 weeks. Since there are 52 weeks in a year, this equals 26 half payments. And 26 half payments is the same as 13 full monthly payments. You sneak in one extra payment every single year without even feeling it. It's the perfect set it and forget it method to achieve the same kind of massive interest savings and shave years off your loan. A word of caution here. Make sure you set this up directly with your lender. Some third-party companies will charge you a fee to do this, which is a total scam. You can do it yourself for free. Just call your loan servicer and ask. But before you rush off to send extra money, there is one absolutely critical, non-negotiable step you have to take. You must specify that any extra payment is to be applied directly to principal. If you don't, the lender might just hold that extra cash and apply it to your next month's payment, which does absolutely nothing to save you interest. You have to be explicit. Write it on the check memo line, select the option online, or call them to confirm. Always designate extra funds for principal only. This is the secret handshake. This is the command that tells the bank's computer system to actually attack your debt, instead of just prepaying their profit. The third strategy is the lump sum sledgehammer. This is for when you get a work bonus, a tax refund, or an inheritance. You have a choice. You can buy a new car, go on a lavish vacation, or you can take a massive chunk out of your mortgage. Let's say you get a $20,000 windfall. Applying that directly to the principal of our example loan in its first year would instantly eliminate the last 2.5 years of payments and save you over $47,000 in future interest. It's like a time machine for your debt. Now, as you start making these extra payments, you might wonder if your monthly payment will go down. Usually it won't. You'll still be required to make the same original payment, you'll just finish the loan much faster. However, there is an advanced move called a loan recast or reamortization. This is different from a refinance. A refinance is a brand new loan with a new interest rate and new closing costs. A recast is much simpler. If you make a large lump sum payment, you can pay your lender a small fee, maybe a few $100s, and they will recalculate your monthly payments based on your new lower balance, but keep your original interest rate and term. This is a fantastic option if your goal is to lower your monthly expenses rather than pay off the loan early. It gives you more breathing room in your budget. So why does all of this matter so much? Because we've been conditioned to see a mortgage as a ball and chain, a 30-year sentence. But that's the wrong mindset. A mortgage is a tool, and by paying it down faster, you're not just getting out of debt. You are converting your home from a liability into a powerful asset. You are building equity. Equity is the golden ticket. It's the portion of your home that you truly own. It's the current market value of your house, minus what you still owe on your mortgage. When you first buy, your equity is just your down payment. But every single time you make a principal payment, your equity grows. When you make extra payments, it grows exponentially faster. And once you have significant equity, you unlock a world of financial possibilities. You can borrow against it with a home equity line of credit, or a HELOC, to fund home renovations, pay for college, or most powerfully, to invest in other assets like a rental property that generates its own income. This is how real wealth is built. Not by simply living in a house for 30 years, but by strategically turning that house into a financial engine. Your home stops being just a place to live and becomes the foundation of your entire financial portfolio. We've come a long way in this series. From the first spark of an idea, the dream of owning a home, all the way through the gauntlet of pre-approval, the emotional roller coaster of house hunting, the strategic battle of making an offer, the nerve-wracking silence of underwriting, and the triumphant moment of closing. We've demystified the jargon, pulled back the curtain on the process, and given you the playbook that banks and real estate agents use. But this final piece of the puzzle, understanding how to manage and conquer your mortgage after you have the keys, is what truly puts you in control. It transforms you from a passive debtor into an active architect of your financial future. The mortgage is no longer the monster under the bed. It's a set of rules to a game. And now you know how to win. Your home isn't the finish line. It's the starting block for the life you want to build. Now go build it.